Inside a room in Doha, Iranian and American negotiators remained seated face-to-face at the same table. At the exact same time, a drone was brought down today. Fighter aircraft came under fire. New United States military operations struck launch positions in southern Iran. Iran's foreign ministry formally accused Washington of violating the ceasefire. Yet the top negotiators never left the room. That single fact became the most critical signal moving through global macro markets today. Most mainstream coverage treated the situation as disorder. They described panic and contradiction. But the contradiction itself is the story. What unfolded today matters directly for every troy ounce of silver and every gram of gold moving into the next 3-day stretch of the 2026 commodity cycle. Only 48 hours earlier, on Sunday night, silver futures opened the overnight session and surged toward the upper 70s range. The movie followed a major diplomatic breakthrough quietly confirmed over the weekend. Officials described a 3-phase agreement framework between Washington and Tehran as a fairly robust proposal already on the table. The administration stated the deal had been mostly negotiated. International mediators confirmed memorandum language was still being refined. Iran's foreign ministry announced that agreement had already been achieved across many major issues. Optimism surrounding the deal reached its highest level since the original disruptions began back in February. That overnight rise in silver priced in one precise macro outcome. Markets were betting on a complete reopening of the Strait of Hormuz. They priced in easing global energy inflation pressure. They assumed the central bank would no longer need to signal additional rate hikes because energy-driven inflation at 3.8% would begin cooling. The market also projected a rebound in silver's industrial manufacturing demand as global shipping routes normalized again. Electronic paper markets absorbed all of those expectations in one overnight session. Then Monday arrived. Central Command confirmed new defensive strikes in southern Iran. The targets included missile launch, infrastructure, and fast boats allegedly preparing additional naval mines inside shipping corridors. Officials stated the ceasefire technically remained active even while senior Iranian representatives boarded aircraft bound for Qatar. Then came today. Military forces released a formal declaration claiming they had shot down a United States surveillance drone over the Persian Gulf. They also claimed an additional unmanned aircraft and an advanced fighter jet were fired upon before the aircraft withdrew from Iranian airspace. Iran's foreign ministry issued a direct condemnation. Officials labeled the latest incidents a serious ceasefire violation and warned that any hostile action would receive a response. State media carried the reports. Multiple international agencies independently confirmed them. Mainstream outlets looked at two simultaneous realities: active military confrontation on one side, continuing diplomatic talks in Qatar on the other. They interpreted the situation as confusion and collapse. But the structure has remained consistent since the April ceasefire began. Across at least 4 confirmed occasions during this conflict period, both sides escalated military activity while increasing diplomatic engagement at the exact same time. The pattern repeated every time. Previous agreements that truly collapsed across the region shared a completely different structure. In those cases, one side withdrew its delegation, publicly announced negotiations were suspended, and allowed at least 72 hours to pass without reopening diplomatic channels. None of those signals appeared today. What actually happened was something else entirely. While military units brought down a drone and fired at aircraft, Iran's parliament speaker arrived in Doha during the same period to resolve the largest remaining financial dispute blocking a peace agreement. The issue centered on frozen escrow funds. Independent international tracking agencies confirmed the specific amount involved. Any final memorandum of understanding would require the release of $24,000 in frozen Iranian assets. Iran demanded exactly 50% of that sum, or $12,000, become immediately accessible once the agreement is officially signed. The remaining $12,000 would transfer during the following 60-day negotiation period. The high-level visit to Doha focused specifically on solving the banking barriers tied to accessing that first $12,000. That commercial negotiation was underway while the drone incident unfolded. Leadership figures were sitting in Qatar negotiating the exact transfer mechanism and payment structure for the opening stage of an economic peace agreement, while hardline military factions simultaneously targeted a surveillance aircraft in the Persian Gulf. This was not a government abandoning diplomacy. It was a government operating 2 parallel tracks at the same time, because each track addressed a different strategic and domestic audience. The political leadership is focused on the economic survival of a country that urgently needs access to $12,000 in frozen liquid assets. The military side is speaking to a domestic hardline audience that expects displays of strength and military legitimacy on the world stage. Both dynamics are active at once, both are genuine. But electronic paper markets focused on the wrong signal over the weekend. What none of the political performance changes is the underlying physical structure of the COMEX vault system. That mechanism does not react to diplomatic messaging. does not respond to military declarations or negotiations in Qatar. It responds to one factor only. Can industrial procurement managers still secure physical silver through ordinary global supply chains, or can they not? And the official timeline for clearing naval mines from shipping routes is now longer than it was 48 hours earlier. That detail matters more than any other development here. Independent reporting confirmed the three-phase agreement structure contains a mandatory post-agreement mine clearing period lasting exactly 30 days. That 30-day process cannot begin until an official signing takes place. No signing has occurred. Today's drone incident and fighter aircraft confrontation extended the realistic timeline for when such a signing could happen. Every additional day before a formal signing ceremony means another day of major supply chain uncertainty for industrial procurement managers. Each day of instability in shipping routes makes a physical COMEX delivery position appear far more rational than rolling paper contracts forward. The current exchange data tells the real story. Registered deliverable silver inside exchange vaults now stands near 81.7 million troy ounces. Total paper open interest across all silver contracts equals roughly 507 million troy ounces. That creates a paper leverage ratio of 6.2 times against every single troy ounce of registered deliverable silver available in the system. The delivery coverage ratio currently sits at 16.1%. Independent institutional tracking metrics classify that level as tight. The exchange remains only 1.1 percentage points above the formal 15% systemic stress threshold, while only 3 trading sessions remain before first notice day for the June contract. Physical delivery figures reveal the deeper trend. The May delivery cycle has already processed 5E684 contracts, representing 28.4 million troy ounces of metal moving through the system. That pace stands 71% above April's total of 33,313 contracts. Demand for a physical delivery accelerated sharply while paper pricing moved downward. This was not panic behavior. It was calculated and rational. No manufacturer can depend on silver shipments through a strait filled with naval mines if that material must arrive at a semiconductor production facility within 6 weeks. Today's military escalation did not weaken that logic. It reinforced it completely. Attention also shifted toward the durability of the proposed peace arrangement. Several observers had already identified this exact escalation scenario before it reached the newswires. The people who raised concerns over naval mines, those questioning the stability of the ceasefire, and those arguing that neither side could fully be trusted were all proven correct. Those warnings arrived early. This community recognized the structural weakness hidden beneath the optimistic Sunday headlines well before mainstream coverage caught up. The objective has always been to build a macroeconomic framework sharp enough to detect these structural signals before they become dominant news stories. Focus now shifts entirely toward gold, the institutional anchor metal, while silver remains the high volatility tactical instrument. When military escalation headlines emerged today, gold reacted immediately. Silver stayed trapped inside a narrow range. That divergence was not random. It reflected the institutional playbook unfolding in real time. Gold responds first and fastest to geopolitical risk because its monetary safe haven role activates the moment either side demonstrates military credibility. Silver reacts afterward because its physical demand depends on whether shipping disruption timelines are expanding or contracting. Gold moved first because of the military headlines. Silver's explosive follow-through will arrive once the frozen funds transfer mechanism is resolved and the official signing window opens again. The question is not whether silver will move. The real question is whether the move comes from confirmation of a peace agreement or from accelerating physical delivery demand tied to supply chain stress. At this moment, both catalysts remain active simultaneously. Mechanically, both point in the same direction, only the timing differs. Kevin Warsh officially took the oath as Federal Reserve Chair on May 22nd. He inherited a committee where leading governors already signaled that rate hikes could return because inflation at 3.8% has remained above target for the 6th straight year. He also stepped into a conflict where the energy component responsible for the largest portion of that inflation reading became even more uncertain during the past 12 hours. Independent institutional analysis confirmed that Warsh's monetary framework centers on a rules-based balance sheet reduction strategy for monetary management. That approach removes the artificial suppression previously placed on gold's safe haven premium through forward guidance under the prior administration. A central bank that no longer suppresses the safe haven bid allows markets to correctly price military escalation risk. Smart money is already positioning accordingly. Attention now turns to the tactical framework for the next 3 trading sessions. For physical bullion holders, the most actionable data point tonight is the Exchange Daily Warehouse Report. If registered, silver falls from the current 81 point. If tonight's warehouse release shows registered silver falling below 81.7 million troy ounces, it confirms that industrial procurement managers had already started standing for physical delivery before this recording even took place. If the registered silver number remains stable or moves higher, then delivery pressure is still building underneath the system, but has not yet forced open the vault structure. At this moment, the vault figure is the most time-sensitive number anywhere in the macro market landscape. Not the headlines, not the spot price, the vault number. For PSLV holders, today's escalation actually strengthens the broader structural setup. It expands the volatility range in paper silver trading. That temporary widening increases the gap between PSLV share pricing and the net asset value of the physical metal stored at the Royal Canadian Mint. Metal secured in a segregated, fully allocated, fully audited vault in Ottawa is unaffected by military claims coming from Tehran. What reacts is the discount between the share price and the underlying metal value. The larger the paper market swings become during a downside move, the wider that discount grows. And the wider the discount becomes, the larger the automatic compression opportunity turns into once the paper market stabilizes again. When stability returns, PSLV holders are positioned to benefit not only from the metal itself moving higher, but also from institutional compression within the pricing gap. For SLV holders, the key metric is tomorrow's official exchange report covering June open interest. If June open interest falls by 500 contracts or more each session, then the paper rollover into the July contract month is progressing smoothly. In that scenario, the delivery period passes without immediate exchange stress. But if June open interest remains sticky and declines by fewer than 200 contracts per session while only 3 trading sessions remain, then the standing for delivery signal is unfolding in real time. The distance between those two outcomes is the difference between a controlled week and a major liquidity shock specifically affecting SLV shares. For AGQ holders, today's environment places far greater importance on position sizing than on exact entry points. The embedded 2x leverage inside AGQ was built for clean and sustained directional momentum. What arrived today instead was violent intraday movement in both directions at once, as trading algorithms reacted simultaneously to military claims and continuing negotiations in Qatar. A leveraged position, sized correctly for a weekly directional trend, can still be destroyed by a severe intraday drawdown if leverage remains uncontrolled during an overnight session, where a drone shootdown and a $24,000 transfer negotiation are happening simultaneously. Risk sizing must come before price watching. Attention then shifted to one final development that received almost no mainstream financial coverage today. Iran's civilian internet access is now being fully restored. The government announced that complete international internet connectivity would return within 24 hours following a direct executive order. That represents a full restoration of the stable conditions that existed before the conflict escalated back in January. Restoring internet access is not a military escalation signal, it is a domestic normalization signal on a massive scale. A government preparing for a full-scale military confrontation does not restore civilian international internet access. On the same day, its forces claimed drone shootdowns. A government preparing its population for a major diplomatic settlement restores civilian normality as a tactical indication that stability is returning. That detail never appeared in the mainstream panic coverage today. Yet, it aligns directly with the parliament speaker being present in Qatar negotiating the $12,000 phase, one transfer mechanism, instead of remaining in Tehran to announce the diplomatic process had collapsed. The next exchange warehouse report now becomes the critical indicator for the entire delivery cycle. The registered silver change tonight will reveal whether industrial procurement managers began standing for physical delivery before or after today's military developments. Every figure remains fluid. Commodity markets continue moving in real time. All numbers should be independently verified before any financial decision is made. Stay alert to the vault data, watch the delivery pressure, monitor the transfer negotiations and the shipping timeline together, because all of them are now connected inside the same market structure. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.